Good morning. Welcome to the Heritage Foundation and our Lewis Lehrman Auditorium. We, of course, welcome those who join us on all of these occasions on our heritage.org website. Would ask those here in-house if you'll be so kind to check that cell phones have been turned off as we prepare to begin. It's a courtesy always appreciated. We, of course, will post the program on the Heritage homepage following today's presentations, and our internet viewers are reminded that they're welcome to send questions or comments at any time, simply emailing speaker@heritage.org. Hosting our program is David Burton, Senior Fellow for Economic Policy in our Institute for Economic Freedom and Opportunity. Mr. Burton focuses on tax matters, security law, entitlements, and regulatory and administrative law issues. He has served several positions prior to joining Heritage: General Counsel at the National Small Business Association, Chief Financial Officer and General Counsel for the Alliance for Retirement Prosperity, and he was a partner in the Argus Group, as well as serving in other finance and tax positions. Please join me in welcoming David Burton. David?
Thank you, John. Good morning. This morning, our topic is venture exchanges, and we're going to examine quite a few different aspects of venture exchanges. But I think the right way to think about that, the whole discussion, is how do we create robust secondary markets in smaller capitalization companies? When people make an investment in a new company, they're always asking themselves, well, when I want to sell, will I be able to sell, and will I be able to sell at a reasonable price in a reasonable time? And that's very much a function of the regulatory space we create for secondary markets for smaller companies. There are a number of different ideas about how to go forward with this, which are being discussed currently under the rubric of either venture exchanges or venture markets. Commissioner Gallagher has been talking a great deal about venture exchanges. Commissioner Aguilar also discussed venture exchanges, and I think offered some constructive ideas about things that we need to consider and be aware of as we move forward. The Senate Banking Committee recently held hearings, and I know that the House Financial Services Committee is also actively considering legislation. There's also lessons that we can learn from experiences abroad and in our own history. The two most prominent examples abroad are the London AIM market, the alternative investment market, and secondarily the Canadian TSX venture exchange. Both of these markets are very successful markets for smaller capitalization companies and enable those companies to raise money more easily and to achieve a better price. I think another thing that we need to think about and examine is why the American Stock Exchange emerging company marketplace did not succeed. As some of you may know, that was an attempt by Amex before it was bought out to establish a small capitalization marketplace that ultimately didn't work out. At least some people believe, because the companies that were successful graduated quickly to other markets, including Amex's primary market, and the ones left behind became to be regarded as limits. In any event, today we have an extraordinarily good panel of people who bring differing perspectives to these issues. And there are a wide variety of sub-issues that need to be thought through and discussed. They're highly knowledgeable, both about policy, but also about how these markets really work in the real world. And it's my pleasure to introduce our four panelists. The way we're basically going to proceed is people will present in the order they're seated on the dais, and then afterwards we will have audience questions and answers. Cromwell Coulson is President, CEO, and Director of OTC Markets, which operates the largest securities market for OTC securities in the United States, and over 10,000 U.S. and global securities are listed there. There are three tiers, OTCQX, OTCQB, and OTC Pink. It is a broker-dealer marketplace and really the dominant player these days in that space. He's a strong advocate of improving the access to capital for small companies and trading transparency. He's testified before Congress and spoken on these and other issues in numerous industry conferences. Prior to OTC Market Groups, Cromwell was an institutional trader and portfolio manager specializing in distressed and value-oriented investments at Securities Corporation. He received a Bachelor of Business Administration from Southern Methodist University in Dallas and graduated from the Owner-President Management Program at Harvard Business School. David Wield is CEO of Wield & Company. He is the former vice chairman of NASDAQ and head of corporate finance and equity capital markets at a major Wall Street firm. He and Ed Kim documented the collapse in small IPOs and listed companies in the U.S., and they argue that the cost to the U.S. economy is over 10 million jobs. He was instrumental, one of the key players in developing the legislation we know as the Jobs Act. He also has been very active in the tick size pilot program, and he is a leading proponent of venture exchanges, the topic of our panel today. And he has an MBA from the Stern School of Business and a BA from Wesleyan University. He studied on the exchange at the Sorbonne, the École de Haute Études Commerciales, and the Stockholm School of Economics. Thea Knight is the Associate Director of Financial Regulation Studies at the Cato Institute. She's an attorney with extensive experience in securities regulation, small business capital access, and capital markets. Before joining Cato, she co-founded and served as general counsel of CrowdCheck, a company providing due diligence and disclosure services in the online investing market, both Title III and Title II, and a number of other things. Following the recent financial crisis, she served as investigative counsel for the Congressional Oversight Panel, charged with overseeing the expenditure of the TARP funds. She spent several years with the Washington office of the law firm Wilmer Hale, and is a relative. She's a relative newcomer at Cato and is doing a great job there. Leonard Amoruso is a partner at Murphy and McGonigal. He's got over 25 years of financial industry experience, specifically in the legal, compliance, and regulatory policy areas. He's with the New York District Office of FINRA, having served as chief counsel and then deputy director. After FINRA, Mr. Amoruso spent 14 years at Knight Capital Group, now KCG Holdings, initially as chief compliance officer and subsequently as general counsel for the parent company. He focuses his practice on securities compliance, regulation, market structure, as well as counseling broker-dealers and financial institutions. He's a graduate of Hofstra University and the Hofstra School of Law. Please join me in welcoming Cromwell Coulson.
Thank you. Make sure that it's working. Great. So our mission is very simple: to create better informed and more efficient financial marketplaces. We use technology and transparency. That's, if we can allow brokers, investors, and companies to make better decisions, markets become more efficient. Our trading platform is an SEC registered ATS. We are considered a super ATS, so we are going to be under Reg SCI for systems compliance and integrity, just like the other, just like national securities exchanges. So we are also the global leader in exchange graduations. The United States leads the world in upgrades. And if we think about venture markets, the one piece is who graduates, where do they go? We have 83 graduates. We've contributed over 400 companies to NASDAQ, NYSE, NYSE MKT over the past 5 years. And we've learned a lot. And that compares, the AIM had 5, TSX Venture 22. But small companies need liquidity. On average, the smallest companies, capitalization stocks, have much less displayed size at all levels of their order book when compared to larger capitalization stocks. That's not me who says that. That's the SEC who says that. And it's true. Small companies do not have order books. And this is a problem because exchanges are matching engines for order books. They can't create liquidity. They can only match what is on the exchange matching engine. Two, we dance around with small companies and we pretend, oh, how do we create this institutional market? You create an institutional market as they grow up. Small companies are owned by individual investors. They're owned by family offices. They're owned by hedge funds. Those are the investors in these securities. They are the ones who are looking around for these securities where the institutions aren't as active. Now, we need to support companies as they become institutionalized, investable securities. But if we want to focus on building good small company markets, we need to focus on creating good markets for individual investors. And individual investors have never had it better. This is Barron's ratings. For every broker, there's a broker for every type of investor. It is an incredible experience what's happened in the last 20 years of the industry. The amount of information that a retail investor, that an online investor has is more powerful than what a professional broker had in their office 20 years ago. And that's really changed the dynamics of the industry. Just like the travel industry, where very few people are calling travel agents. And actually, we have a lot less travel agents. But we have technology where people can see the information to make their own choices. We should build on that. Finally, retail investors love market maker trade execution quality. They also love the cost, and they also love the level of service. What's interesting is, while matching engines have taken the majority of volume in the larger, more high-velocity securities, is still retail investor market orders still go to market makers. And that's because market makers provide a quality execution at a cost that's driven retail trading down to $7.95 a trade. That's incredible. That is such a change from where we were 20 years ago. And also, there's a service level, best execution, regulatory compliance, risk controls. After the Facebook debacle, there were no retail brokers who'd been sending their orders to market makers who complained that the market makers took the loss. They were, in fact, very happy. And as we think about that, this is a platform that can create and provide liquidity that we want to nurture, because market makers are the best suppliers of liquidity for retail investors. So how do we do it? And I look at the exchange space as actually a lot like the New York City taxi industry. If you get an exchange medallion as a national securities exchange, you're the only way that a company can be preempted from state blue sky regulations when you raise capital or for secondary trading. You're the only way for an equity security to get margin eligibility. And guess what? Just like New York City taxi medallions, it's expensive. It's a big cost, but we've outsourced it. So in New York City, we didn't have enough transportation opportunities. So the taxi industry came up with something called borough taxis, or green taxis, as we call them in street slang. They're a taxi with limited functionality to deal with the outer boroughs. And when you think about that, that's what venture exchange is, limited functionality to deal with the smaller companies. And I take a different look, because exchange regulation is very heavyweight. Exchanges, when NASDAQ it was known as an exchange until 2006. When it went from an automated interdealer quotation system to an exchange, it changed from a dealer network, a broker-dealer network, to a matching engine that set priorities for orders. Now, that was a big change, but we lost for small companies that flexibility with different levels of disclosure, of compliance and governance that companies could grow into. And as I look at for technology, how do we do that here? How do we create the future of electronic markets where there's lots of different competitors to do two things for companies: help them raise capital and help them trade securities? And there, Reg ATS is a really interesting opportunity, ATS is Exchange Regulation Light. In many ways, it's the automated interdealer quotation system of the future. Second, markets. NASDAQ's private market. Our OTC Link ATS. We're all regulated by the SEC and FINRA's ATSs. Europe, the AIM market, NASDAQ's First North, the old plus markets, they're all regulated as MTFs, which is Europe's version of ATSs. And the reason is, if you create less regulatory complexity, you will lower costs for users. And that's important. The more regulatory complexity we create, the more cost we create for users. And we slow things down, the less innovation. One set of green taxis or a whole new industry created by technology to fit the different needs. That way, there's not just an eBay, there's an Etsy. There's all these companies that can use technology to help small company capital formation. So the main thing we need is we need to enable interstate commerce. This is so important because you can't have an electronic system if you have to go state by state. So what have we done? Reg A, Tier 2 offerings are preempted from state blue sky. This is the first time we've unbundled from requiring an exchange listing to raise capital nationally. There is continuous disclosure. Reg A Tier 2 does need preemption for secondary trading too, but it's a great start. And this has come out of the Jobs Act. But there's still things to do. It's unbelievable that if you're a fully SEC registered company, you have to go through every state blue sky. We should preempt those. Secondary transactions in SEC reporting companies. There's current information available everywhere for investors. Why is there not one federal standard to meet? Secondary transactions through broker-dealers. Second Markets has gone around to all the states, and they've shown how the hodgepodge of blue sky laws don't work. Nothing's happened. Not a single, there's been no change. 50 different systems you've got to meet. We need one system for when broker-dealers are. We need a national system. And also registration of electronic brokers. If you're starting a portal for crowdfunding, you've got to be a FINRA member. Are these innovative portals going to be able to afford registering 50 different states? Is that going to make our system work? No. You unify markets with uniform securities regulation. It's time to create a national system so we can have electronic venture markets. You also need to unleash the companies. And I really think you need to decouple the freedom to raise capital, the freedom to have transactions, and push it from the exchange level down to the brokers and the companies. And if you free them, the platforms that they use to trade will develop organically. And that is, should you be selling taxi medallions, or should you be making sure that there's appropriate national regulation for the drivers and the vehicles? The drivers are the companies, the vehicles are the broker-dealers. They're all highly regulated. So we got to finish the Jobs Act crowdfunding rules. We also need to establish a path for companies to provide adequate current information electronically. In the old days, the SEC would issue letters and where you'd say, we've sent our information to our shareholders, we're in a securities manual. They stopped doing that. Now, there is no guidance if you're not SEC reporting on how can you provide your disclosure out to the world. And the old securities manuals, no investors look at those anymore. They're in libraries, but they're actually the cornerstone of blue sky transparency, an old paper-based system that doesn't inform investors. We also need to modernize the penny stock definition. And the penny stock definition is really important. It puts higher controls on brokers recommending riskier securities, transacting riskier securities. But it doesn't work for biotech companies. It doesn't work for companies that are R&D heavy that are pre-revenue. So we need to modernize just that one piece of it. We have to deal with the bad parts of small companies. There's a lot of bad information on the internet, and we need more transparency around it. If you Google penny stock and you click on the first ad, Google gets paid $20, and you go to a website which looks really great, it's slick, it's got all this information, but it's completely anonymous. The brokerage industry has a hard time dealing with hidden bad people. We need more transparency to fit the internet age. And we need to remove complexity and cost for companies. You know, every place that we've got complexity and cost hurts companies. So the broker-dealer ecosystem is the other piece. You need broker-dealers. You need to support small broker-dealers, and you need to support market makers. We have fewer. We need more. We should focus on point-of-sale disclosure. That's what makes markets efficient. Transparency. We have electronic access to investors. Let's make sure the point-of-sale disclosure tells what information is available, what's the risk profile of this security, and then understand that investors will make good decisions. Not all investors will make great decisions, but if you have good disclosure, transparency of companies and of risks, most investors will make good decisions. We also need to update Reg SHO, because Reg SHO restricts the ability of market makers to have balanced books, to be both long and short. And it needs to be thoughtfully streamlined because we can't have an increase in manipulative short selling, but we do need to allow market makers to be able to provide two-sided liquidity to investors. And what happens is, if market makers can't have a short book, they can't have a long book. That removes capital from the market. You need a balanced book. And we need to streamline the on-ramp for OTC trading. You can't pay an investment bank to do the research to come public on our market. That's ludicrous. And it's also created a black market. We need to make DTC eligibility easier. We need to do the things that lower costs for companies to come into the capital markets, to enter capital markets. And we also need to expand margin eligibility. The Fed used to have an OTC margin list before NASDAQ became an exchange, and then they stopped doing it. We should have standards for equity margin, and not for every company, but if you're a community bank with 10 market makers publishing two-sided quotes, and you've got $100 million worth of book value, and you're not on NASDAQ, you should be a margin-eligible security. You make capital worth more by making it transferable and making it lendable. And enable technology and transparency. Regulation is so much easier for using transparency and technology. So this is my view of the future. It's a future which has steps up into the capital markets. You've got graduated disclosure. Technology and transparency are our friends. Cost and complexity are our enemies. So thank you.
Thank you, Cromwell. David?
Okay, how do I get the presentation up? Do you know?
Well, the short answer is, it would operate just like another computer, so I guess it
See if we can find something in here.
maybe just,
Is it, do you think, oh, that's the transmitter.
I don't know if they have yours.
You don't know if they have it? So,
I know that I handed out the paper version of it. The question is, do we have his?
it was a Wheelden Co presentation.
Yeah.
Do you have it on a USB?
The paper version of yours has been handed out.
Yeah, so I don't think that's gonna work particularly effectively for the audience. Let me see if,
Do you need a copy of it?
no, I don't mean. I don't have it on the USB.
David? Yeah, we could do it.
Yeah,
out.
why don't you
We'll do it out of sequence, and then I'll get the electronic version. Okay, how's that?
Yeah, okay, I mean, I can, yeah,
Why
why
don't
don't
you?
you,
I can send it to him.
Yes. All right. Yeah.
Good morning. Thank you, David, for the introduction and for hosting this event today. This is obviously an important issue that we need to address in the small business space. I don't think there's much disagreement about the fact that smaller companies are having trouble accessing capital. Even before the financial crisis, small business lending was contracting. Recovery has been slow. In the meantime, our capital markets were contracting as well. We have seen something of a decline in the number of IPOs in recent years, and companies are taking longer to go public. Fewer IPOs and a longer timeline to IPO may have a number of unpleasant effects. Capital remains locked up in companies longer, making it less available to fund other new ventures. Due in part to increased regulation of public companies, firms may choose to be acquired rather than go public, resulting in market concentration and reduced innovation. Capital becomes more expensive because investors need something to offset the illiquidity of their investments. In addition, recent changes to securities laws, specifically to the Reg D and Reg A exemptions, are poised to increase the number of tradable securities in small businesses. As it stands, these companies are too small to be eligible to list on larger exchanges and have limited options for trading. If investors are unable to exit their initial investments in these companies, they will be unwilling to invest in the first place, undermining the purpose behind these rule changes. Increased secondary liquidity in small cap stocks would likely reduce many of these effects. And to the extent that willing buyers and sellers are currently unable to find each other, I'm all for improving liquidity. But I would caution against any solution that seeks to inject liquidity where it fails to form naturally. What do I mean by that? Well, there are a number of theories about what might be interfering with secondary liquidity for small cap stocks. One theory is that decimalization has made it unprofitable for anyone to make a market in these stocks. The solution, according to this theory, is to increase the tick size for small cap stocks to encourage people to make a market in them. I'm skeptical of this solution. Artificially increasing tick size only increases the transaction cost of each trade. First, when you want people to do more of something, you rarely make it more costly for them to do it. But second, and more importantly, setting a higher minimum tick size would distort the market and mask information about the value of the securities being traded. Liquidity is valuable, but so is the information provided by a security's illiquidity. Another theory is that market fragmentation has spread trading in these stocks too thinly. To restore liquidity to small cap stocks under this theory, you must concentrate trading in only one or two places. During a recent hearing before the Senate Banking Committee, the witnesses discussed the possibility of restricting trading in certain small stocks to a midday auction on one of the large exchanges, such as the New York Stock Exchange or NASDAQ. Not surprisingly, the New York Stock Exchange and NASDAQ thought this was a pretty good idea. These exchanges are good at and make their money from handling market giants, GE, Exxon, Microsoft. But how does that prepare them to handle a small biotech firm raising $50 million? And how much is it worth to them to spend time and effort optimizing the small cap market? The best way to help smaller companies is not to use regulation to give more power and control to the largest exchanges. Finally, another solution is to create a new exchange, one focused specifically on small, young companies, a venture exchange. This isn't a new idea. NASDAQ started out as essentially a venture exchange. Toronto has a venture exchange, so does London. So why not create a new one in the US? Well, there is nothing inherently problematic about the existence of such an exchange, but there's very little to recommend it either. First, it takes time to establish an exchange. Rules must be written, structures put in place. The process of writing rules, fighting over them, writing them again, fighting over the changes could take years. But more importantly, how many exchanges would there be? And would there be alternative venues for trading? Most proposals contemplate only one exchange, mainly to address concerns about market fragmentation. Market fragmentation is real, but I'm skeptical that the solution is to artificially concentrate trading on one exchange. Let's think about this. Suppose a stock exchange is like a social network, and liquidity is like a measurement of how many people are active in that network. Because as with an exchange, you only want to be a member of a social network that has lots of members and members of the type you want to connect with. If we create just one exchange, it's like creating MySpace and mandating that everyone stays there. No creating Friendster, no Facebook. No need for the first version to be updated to retain users. We might reduce market fragmentation, but at what cost? Will the functionality be good? Maybe. But with little incentive for the exchange to innovate, absent competition, we won't know. What is the solution then? As I said, I'm interested in market efficiency. We do have unnecessary friction in the markets currently. It is harder than it needs to be for buyers and sellers of small cap stocks to find one another. if I may again analogize to popular websites, what we're lacking is the eBay or Craigslist of stock exchanges. In the past, if you had an item, a secondhand stroller, for example, to sell, it was extremely hard to advertise for exactly the right buyer. It was often just too expensive for you to reach them. Now you'd put the stroller on Craigslist. The internet is extraordinarily good at reducing transaction costs. Why not use it to help improve liquidity for small cap stocks? Well, unfortunately, there are a number of regulatory restrictions that make it difficult for anyone to set up what we might call a Craigslist for stocks. Reg ATS would require anyone operating such a site to register as either an exchange or a broker-dealer. Various blue sky laws would require that the site's operator ensure compliance with 50 different regulatory regimes. The site would risk designation as an underwriter, which carries its own hefty regulatory burden and compliance risk. My proposal is that we could create an exemption under Reg ATS for online bonds that simply match buyers and sellers. If a simple exemption makes people too nervous, I would suggest a special designation that would be very lightly regulated. This designation would also serve as a safe harbor from designation as an underwriter, and there would be full federal preemption of state regulation for trades on these sites. The crowdfunding provision of the Jobs Act has its problems, but the funding portal concept has some merit. I envision something similar. For buyers looking for more assurances, there might be an intermediate tier between a Craigslist-style board and a full brokerage. While it might be possible to use regulation to define this level, I believe if buyers are looking for assurances, there will be those in the marketplace willing to provide them and act as a trusted go-between without requiring additional regulatory categories. Of course, creating such a system would have several logistical issues. For example, how does a buyer verify that the stock certificate the seller holds is valid or that the seller has the right to sell it? I don't find these logistical problems to be worrisome, however. There's money to be made in solving them, and there are people already working on private market solutions. A company might decide that it would be profitable to act as a middleman in these transactions, for example, validating the stock certificates and ownership on behalf of the seller. Another concern is that there is insufficient research and analysis of these stocks. The market is opaque, and this opacity can both distort price and discourage trading. Increased tick size has also been cited as a solution to this problem. Increase the payoff for dealing small cap stocks, and dealers will increase their efforts in researching the companies. Increased transparency is a great goal. But before we add new costs to the market, let's try lowering regulatory barriers. As David said before joining Cato, I helped to found CrowdCheck, a company providing due diligence and disclosure in the online investing space. While CrowdCheck was formed to address concerns in investment crowdfunding, it has found clients in the Reg D and other pockets of the small business investing world who are seeking transparency. I foresee other similar solutions developing to add valuable research and analysis for small cap stocks if these stocks become easier to trade. These solutions will never develop, however, if we insist on engineering pricing mechanisms. Will lifting restrictions on these types of online transactions unleash a torrent of pent-up demand for liquidity? I don't know. But to the extent that the buyers and sellers that exist can't find each other because current regulation prevents the use of the most efficient market tool we have, the internet, there's a good argument for peeling back that regulation. In the process, however, let's not create new categories and new structures that serve only to distort the market in the name of liquidity while stifling competition and innovation. Thank you.
Thanks. You probably should go and Leonard.
Since it is always a difficult task following David in a presentation, I'm kind of glad that the virus that I planted in the computer worked and I get to go ahead of him. So firstly, I'd like to thank obviously David and the Heritage Foundation for inviting me to speak today. As David noted, I was formerly the general counsel of Knight Capital Group in Jersey City, New Jersey. And Knight was a wholesale market maker making markets in roughly 18,000 domestic securities and was the leading market maker in the bulletin board and over-the-counter market. So had quite a bit of experience and history at the company dealing with many of the issues that we're talking about today. And it is indeed a very important topic, one that it deserves special attention, not only here in Washington, but more broadly across the market, as these issues impact small companies and their ability to raise capital, prosper and grow in every corner of the country. And we do have a wonderful panel of speakers today who have discussed or will discuss in depth various issues which impact this debate. I'd like to focus my comments a little bit more broadly at first, discussing generally what I'd like to describe as the three legs of the stool which frame the components of this discussion, and then delve a little bit more deeply into one of those legs, and that is the importance of robust liquidity in the secondary markets. As others have said, it's fairly well settled that small companies today now face significant challenges raising capital, and that's due to a number of reasons: the lack of research sponsorship, investment banking support, the increased regulatory burdens, and the ongoing costs of compliance with listing standards. And as you've heard, since 1995, there have been a significant decline in the total number of small IPOs on U.S. exchanges. So what is the practical implication of this? Well, small companies can't raise capital that they need, which tends to stifle growth, innovation, jobs. And also, if small companies have to turn to the private markets for needed capital, then obviously new company price appreciation will accrue to the private equity investors versus the public markets. As noted, the decline in small IPOs may be attributable, at least in part, to the difficult regulatory hurdles for issuers, as well as the illiquidity in secondary markets. And as we've heard, there have been some recent developments in the capital raising space for small companies worthy of note. Crowdfunding obviously is one of them, which is the practice of funding a project using a large number of people, typically via the internet, and established through the Jobs Act, establishes a regulatory structure for startups and small businesses to raise capital using the internet. More recently, on March 25th, the SEC adopted rules known as Reg A+, to expand access to capital for small businesses. And like the rules on crowdfunding, Reg A+ potentially provides small businesses with a larger pool of investors than was previously available by permitting companies to raise up to $50 million. Now, when evaluating any changes in the space designed to help small companies, we need to carefully consider each of the major constituents of the three legs of the stool: small company issuers, investors, and as I said earlier, the liquidity providers in the secondary markets, typically market makers. And when we talk about each of these constituents, we need to balance the key tenets of securities regulation: investor protection and capital formation. As Commissioner Gallagher recently stated in his speech, capital formation and investor protection go hand in hand, or walk hand in hand. Without both, markets cease to operate. So when looking at these issues, a thorough and rigorous cost-benefit analysis is imperative to any proposed path forward. So starting first with the issuers. Now, obviously, they need access to the capital markets for a number of reasons: research and development, expansion, hiring, you name it. And when considering public markets, issuers are often confronted with weighing the enormous cost of going public versus seeking capital privately. And if seeking capital privately, many times giving up a good deal of control of the company. When considering public markets, small fledgling companies also realize that with the lack of analyst coverage, the likelihood of attracting institutional investment is difficult, and the ability to reach retail investors is challenging. So gaining access to a venture marketplace or an exchange could bring the visibility they need. So by way of illustration, as Cromwell pointed out, let's look to what the OTC markets has achieved. In 2014 alone, over 10,000 non-exchange listed companies trade there, companies of varying sizes and market cap, with total value traded in excess of $240 billion. And as Cromwell noted, OTC Markets has made changes in its marketplace with the goal of improving access to capital and liquidity for smaller companies. Approval of trade on OTC Markets allows companies to build visibility and improve transparency for investors. Now, talking about investors, when looking at venture markets, we understand that these markets necessarily mean more risk. And risk is not a bad thing, and we should not look to eliminate risk from our investing assessments. Rather, risk requires fair, accurate, and timely disclosure. Risk requires exchanges and marketplaces to have comprehensive and robust surveillance to weed out fraud and malfeasance. And I'm certainly oversimplifying, but at its core, that's the intent of regulation: fair disclosure and the ability to detect and prevent fraud. Investors want risk as it correlates to reward, but they need truthful and accurate information. So whether through the disclosure requirements of the OTC markets or a contemplated venture exchange, these marketplaces serve the critical function of ensuring there is requisite oversight in a framework of rules and regulations designed to protect the integrity of trading on its venue, and most importantly, protecting the investor. The final leg of the stool is the liquidity provider. Remember, investors, large and small, want to know they can sell their investments at some point. So exchanges can have the most rigorous listing standards in the world, and investors can have the most thorough disclosures in the world. But without vibrant secondary markets to liquidate these investments and transfer risk, the capital formation process will ultimately grind to a halt. In most equities markets, the role of the liquidity provider is typically played by the market maker. Again, exchanges, ATSs, dark pools all do a wonderful job of bringing buyers and sellers together. But what if there is no buyer for the seller or no seller for the buyer? And all too often occurs in small, illiquid markets. And that's where the market maker comes in. In the context of this debate, robust secondary markets are, in my view, the most important tenet. Indeed, the lack of liquidity providers is said to be the cause for the launch delay of Nasdaq's BX and some of the difficulties faced by the Toronto Ventures Exchange, as well as the Amex's emerging company marketplace, its ECM exchange. Now, by way of related illustration, after the so-called flash crash in May 2010, and we're rapidly approaching its 5-year anniversary, 3 of the country's largest market makers, Knight Capital Group, my former employer, Gecko, and Virtu Financial, petitioned the SEC by letter dated July 9, 2010, to consider formal market maker obligations. And the thesis advanced was simple. We need to have proper incentives and obligations in place to ensure market makers remain an integral part of our markets. The liquidity and stability they provide are invaluable to the resilience of our market. So, for example, and I think Cromwell touched on this, things like regulation SHO need to be added to the overall debate. Today, market makers are required to close out short positions within a few days of failing to deliver, and as such, market makers cannot sell to buyers in thinly traded securities unless they're confident that they can cover that short position quickly, which in illiquid securities is often not the case. So very quickly, the viability of venture exchanges in the U.S. The SEC has approved a venture exchange in 2011, the BX venture exchange created by Nasdaq. The venture market was designed for smaller companies contemplating an initial an initial listing, and for securities of smaller companies that are delisted from other national exchanges for failing to meet listing standards. To date, the BX venture market, as I noted, has not launched due to concerns about ensuring adequate liquidity in BX-listed securities and attracting liquidity providers. London's alternative investment market, AM, the AIM market, was founded in '95, has roughly 1,100 listings, including 900 from the UK and about 200 abroad. And then finally in Canada, the TMX Group runs the TSX Venture Exchange, has roughly 80 U.S. firms that list on that market of 2,000 plus listings. So just by way of brief recap, for investors, venture exchanges can offer a transparent, well-regulated environment for trading stocks in smaller companies, which combines enhanced liquidity and strong investor protections. For smaller companies, venture exchanges offer opportunities to raise capital and attract investment from investors that may have otherwise been unavailable to them. And for the marketplace, venture exchanges support capital formation for smaller companies' ability to raise capital on more favorable terms. And with a network of liquidity providers and market makers, investors will have an efficient means of liquidating their positions when they are ready to sell. As we discuss, some of the key challenges for venture exchanges will be balancing lower listing standards with investor protections. The SEC will have to carefully scrutinize proposals to establish venture exchanges and marketplaces to determine that there is an appropriate balance of lower listing standards with rigorous vetting, surveillance, and examination. A key to success of venture exchanges will be how they maximize liquidity in secondary market trading. Batch auctions and centralized liquidity on venture exchanges have been raised as items for consideration. But to be clear, to truly promote robust liquidity, venture exchanges will need to attract dedicated liquidity providers with a package of benefits and obligations for market making in listed companies. Thank you again, David, for the opportunity to speak and present some of my thoughts on these topics.
Great, thank you. David, we have it up now, and I believe that will advance your slide.
Okay, well, this is the paper. This is not the presentation, so
Maybe.
I think we're maybe back to, I hate to do this to people, but that's, let me what has he got up here? Yeah, no, this is, this is the papers, this is not the presentation, so if everybody can bear with me, I'm gonna just grab it off the desk. There's a PowerPoint presentation, and can I just plug this in? I should be able to, right?
Yeah, you would think.
And then maybe, and then what I'll do is I'll just sit here so I don't,
Definitely a Reg SCI event. Be nervous, it's expanding to brokers.
oops, I just hit the wrong button. I'm gonna reboot. Well, everybody else get the present? I sent a deck out, right?
Yeah.
Did you get it? You got
Yeah.
it? Yeah.
So,
Probably in your. You know, while I'm waiting for this to come up, I would just, I couldn't agree with Len more in the sense that you got to figure out how to create liquidity. It's a really trivial exercise to match buyers and sellers together. I mean, I hate to say it, but that's not a problem. You can post bulletin boards. We've been doing it forever. If you look at Regulation NMS and 50+ trading venues, electronically, you can collect all the liquidity that's fragmented. That's not the issue. The issue is getting the value providers in there to provide research, sales, capital commitment. They have to have an economic model to do that. And, information mining, which is looking at, at how stocks have behaved, their historical presentation, that doesn't get you anywhere. What you really want to know with a stock is what's the future hold, what's future earnings potential, particularly when you get into non-revenue, heavy intellectual property companies like biotechnology. It requires human beings doing careful analysis and assessment and then going out and talking to other human beings, investors, and creating orders that didn't otherwise exist offset. So you got a big seller and no buyer. How do you find the other side of the trade in a stock which is otherwise very, very small and not particularly well known? And that is what academics generally call an asymmetrical order book stock, with big buyer, no seller, whereas the natural state of large capitalization stocks, the Intels, the Exxon Mobils of the world, is that you've got massive numbers of investors looking at these stocks at any particular point in time. And so just get out of the way and let the order books, the orders interact. That works just great. But it's a total disaster for small micro-cap stocks. And so what we've had in the United States has been, what we started calling, and I think the SEC chair has picked up the lingo too, one-size-fits-all markets, and questioning whether or not one-size-fits-all markets make any sense. And I can tell you, as a practical matter, they do not. They're stupid, and they've cost this economy, in our view, about 10 million jobs. And let me see, see if I can grab this here real quick. Desktop. And I have a file on venture exchanges, Heritage Foundation, and there we go. So I don't know if we can, so there's the deck, but I still don't have it up top.
It was up for some, there you go.
There we go, okay. So I'm gonna put it
back in business.
on view, and I'm gonna screen through these slides. I think that there's there should be a review slideshow. There we go. From beginning.
It's okay. Technology's tough for guys who came on Wall Street
Hey,
when there wasn't technology.
Look at my gray hair. I used to have punch cards in
Yeah,
business school.
the guy trying to look up quotes on his phone keypad. Yeah, that's tough.
Okay. So
The young kids are going to crush us. They've got that interweb.
okay, here we go. So, who are we? And I just want to make it clear a couple of things really quickly. we're innovators in capital formation. I'll just skip down, but we develop innovative platforms and services to greatly improve corporate client access to public capital. We conduct research into how market structure impacts access to capital and economic growth. A couple of the papers that we wrote, really were the beginning of the head of the House Oversight Committee's letter to then Chairman Shapiro, that kind of triggered a lot of the discussion around. We were the first two citations in his letter on what happened to the IPO market in the United States, and we've subsequently. I actually just got back from Istanbul speaking at the G20 event because of a paper that we wrote for the OECD that actually looked at tick size as a percentage of share price, and it actually shows that that aftermarket economics are one of the greatest predictors of small IPO activity there is. We had a very high R-squared in the econometric models we wrote, and so what it basically says is that you need aftermarket incentives in the dealer system in general to be able to get people to create liquidity. Otherwise, the systems start to break down. The United States, for what it's worth, has the smallest aftermarket incentives of any market in the world. And we've done that. It's the classic self-inflicted gunshot wound for a variety of reasons. People don't understand that because of U.S. brokerage industry conventions, we cannot solicit in this country stocks that are under $5 a share. Most of the brokerage firms won't let you do that. You can't own those stocks on margin. Okay, so those two things together mean that if you want to split your stock as a company to get the tick size as a percentage of share price up, you don't have the ability to do that because bad things start to happen. Brokers can't get on the phone and solicit your stock any longer. So our research informs our products and services and is used to support policymakers in the quest to improve markets to support the common good. Now, one of the things that we do not do, and I think it's important for people to understand this, we don't trade securities. Okay, so we don't have a dog in the hunt of when we tell people you have to raise the economic incentives for traders to support securities. We are not a beneficiary of that, right? And the reason why we've steadfastly stayed away from making markets and securities. We own a broker-dealer. Two reasons. One, we think it's not a profitable business, and it's it's just not a place that we want to be. But we do want to support small cap companies. And secondly, obviously, it creates a real conflict around the advice that we give. So for those of you that don't know, in 2011 we actually wrote an op-ed in the Wall Street Journal, and one of the conclusions I'll read you is what's needed now is a new parallel market for public companies under $2 billion in market value. Trading rules in this new market would allow for higher commissions, trading spread, however you get the economics in there is the point, which would provide adequate incentives to small investment firms to get back into the business of underwriting and supporting small cap companies. The SEC could use its authority under securities laws to exempt this market from rules standing in the way, or Congress can step in. And that was 2011, how to revive small cap IPOs. I've talked a little bit about this, but the tick size pilot comes from us, and it came from a dinner we hosted for the then Vice Chairman of the House Subcommittee on Capital Markets, and we had people from NASDAQ and the New York Stock Exchange that were in the room, people that had done research on the sell side, one of whom had run equity research at Merrill Lynch, and people thought it was a very simple way to get some incentive back into making markets and creating an information effect around these stocks. As I think David, and by the way, David, thank you for putting this together. I mean, he's spot on. The Achilles heel of the Jobs Act is that it did nothing to improve aftermarket support and institutional liquidity, in particular, liquidity in these stocks. I think that people don't realize at sort of the 11th hour that we'd worked to put in to get an amendment through the Subcommittee on Capital Markets into the Jobs Act that would require the SEC to study and report on tick size. People were started to understand that, and that was really largely to get the discussion about the aftermarket going. Because you could get rid of Sarbanes-Oxley tomorrow. You're not going to bring back small cap IPOs in this country. It's just not going to happen. As I mentioned before, there are two distinctly, and this is how academics look at these stocks, right? This is symmetrical order book markets, which are large cap, innately liquid, and they're not in need of intermediaries, really. And then there are asymmetrical order book stocks, which are small cap stocks, micro cap, nano cap, naturally illiquid, and they depend on intermediaries. And when you nuke the intermediaries so that nobody can make any money, okay, then you nuke the liquidity, and you nuke, and essentially you pull the carpet out from under the entire market. So this is actually a slide that was put up in the House Subcommittee on Capital Markets quite a long time ago, an earlier slide. And on the far left is 1991. On the far right is the year-end 2014. And what you're seeing in the yellow tranche is the percentage of IPOs that are $50 million and larger. And in the blue tranche, it is the percentage of IPOs that are $50 million and smaller. And the years where it just falls off a cliff are 97 and 98, which is the implementation of the order handling rules and Reg ATS, which was the dawn of electronic order book markets. And what happened was we took all of these limit orders and we put them onto an electronic board, and we went essentially overnight from mostly quarter point trading spreads that were quoted markets where market makers could manage their risk, to where we had the minimum tick size started to define the minimum economics. So it dropped from a quarter point down to a 30-second or 3.125 cents. And what Wall Street did was it acted en masse to cut commitments to small micro-cap stocks. Why? Because they were all of a sudden overnight losing money on stocks that they once started to make money. And by the way, I'm not making this up. I ran banking, research, sales, and trading at Prudential Securities, the strategy, and we did exactly that. We had to start cutting commitments to these stocks and focusing our resources on larger market value stocks because we're not in the business. We were not in the business of losing money. So they became very unprofitable. You know, this is what we talk about in terms of infrastructure. If you look at the number of Wall Street firms that book ran at least, and these are all firms that were providing research coverage for the most part too, that book ran at least one small IPO in 1994. Remember, the dot-com bubble doesn't start to really crank until 1996. So it's before the dot-com bubble. There's 162 book runners of small IPOs. Fast forward in 2014, which everybody says was the best IPO market since 2000, since the end of the dot-com bubble, and that group of firms is down to 31. Okay, we've collapsed that whole infrastructure that in the United States was required to support small cap companies. And I ask you, what's come back to replace that? The answer is nothing. So all in the pursuit of low-cost trading, and I'll tell you, the low-cost trading is not the answer in micro-cap, small-cap names. The cure was much worse than the disease. People need jobs. Why does it matter? Okay? Now, this is labor participation rates, okay? And it goes back to 1978. And by the way, if you go back to the 70s, you'll find that small IPOs dominated the landscape, the 80s, the 90s, and then all of a sudden we changed market structure, poof, and it never recovered. And why is that? Because there's more small companies than there are large companies. So, of course, what we did was we dramatically raised the bar on companies going public and accessing capital. I don't have the data here, but I'd refer you to, there's a great piece by the economist Robert Lighton in Foreign Affairs. And in it, he shows that going back to the 80s, we were running about 14% of all companies in the United States were startups. Okay, they were less than 1 year of age, and today it's about 8%. So this creates a vicious circle, which is why you're depriving capital companies to go public, then we're not sprinkling more startup capital in the economy. It gets progressively more difficult to start smaller companies. So labor participation rates are now down at exactly the level that they were back in 1978. Interestingly, we have other data that looks at the number of listed companies, and we're down today from a peak of about 9,000 listed companies to 5,000, back all the way, done a round trip similar to this labor participation rate statistic. And, you know, interestingly, if we had done nothing to our market structure, we project that we should have, instead of having 5,000 listed companies today, we should have about 13,500. And that, my friend, that delta is probably 10 million jobs to the U.S. economy. Now, when you look at labor participation rates by age group, this is the 16 to 19 year age range. You can see that it dropped dramatically. Okay, you can see that for people in the core of their career, 25 to 54 years of age, labor participation rates are down very significantly. And this is the one that I absolutely love. This is retirees. These are people over 65 years of age, okay? And their labor participation rates are going up. Why? Because they can't afford to retire, okay?
Isn't that a Social Security?
What?
I mean, it's more a Social Security thing.
What?
But that's off
Well,
topic.
they're people are
Yeah.
staying there. They're
People
holding on
wanna
to
keep
their
working,
jobs
yeah.
longer.
Yeah.
What?
Yeah.
And because I think that they have to. So for-profit changes are going to do, in my view, a really poor job at this. Why? Because it's not about stock exchange economics. It's about dealer system, ecosystem economics, okay? If they're not incented to provide the value, then they will not provide the value. And so when we go through, and I've spent time over at the LSE with Marcus Studdard, who runs the AIM market. I've spent time with Kevin Cowan, who is at the TMX Venture Exchange. And we've looked at the Deutsche Börse because they had something called the Neumarkt. And in every instance, what happens is the for-profit exchanges have been, sort of interested in improving their own economics to the detriment of the dealer community. And we see examples where they've done that. And as a consequence, the dealer community is all of a sudden under pressure. So a good example of that would be the LSE took the top end, the more liquid AIM stocks, and they promoted it. They promoted them into the electronic order book market. They still call them AIM stocks. And we heard that from Winterfloods, which is one of the largest market makers in the European markets. The rest of the stocks were on a dealer system akin to the old NASDAQ market. TMX Venture, I mean, if you go back, it was the old Vancouver Stock Exchange, was a dealer market. They converted it into an auction market. And so what I'm saying is that there's ways that we can do these things. I don't want to, there's too much detail there. But our view is that, one of the reasons why smaller capitalization stocks have smaller retail, and on average, I mean, there's no question that when they get smaller, that there tends to be more natural affinity with retail. But the fact of the matter is that the reason why institutions don't play is because there's not institutional liquidity there. And so if you can introduce more market-making activity and get market makers to have an incentive to shoulder that risk, you'll see some of the $20 trillion in equity assets get tilted down into the micro-cap market. So increasing that incentive, I think, is absolutely critical. So what do we say? Venture exchange essentials to get these things to work. I believe that they should be, at least you need to create a construct to allow them to be member-owned and governed. You could have a for-profit exchange, but if it's run by the dealers, they're going to make sure that there's a balance between dealer profitability and the needs of investors. That was the old NASDAQ market, and it worked extremely well as a venture market. You don't have to change listing standards, if you will. You just need to bring back those smaller IPOs that are currently qualified but can't get adequate support. And one of the big concerns about Regulation A+ is great to enable a lower cost construct and a $20 million IPO with a preemption of State Blue Sky. But if you can't support them in the aftermarket, I'm not sure you've done anybody a great service. Listening to Cromwell, we clearly agree that there should be broad exemptions in certain areas. I mean, just let people start from scratch and create new stock markets, and that includes everything from. It doesn't mean that they can't decide to put in their version of water handling rules or ATSs or decimals or something like SOX or UTP or NMS or Blue Sky, but they need to have the ability to stop. And as Cromwell mentioned, Blue Sky. Blue Sky is a travesty in this country. The smallest companies have two layers of regulation, if you will. It creates incredible uncertainty. You don't know what states you're gonna apply. And these are the smallest companies that least need a higher amount of cost. It's just crazy that we permit that to happen. I know that under Regulation A+, we now have two tiers above 20 million. They're preempted from State Blue Sky. My understanding is that they entered into a grand bargain, if you will, to at least leave sub 20 million with the State Blue Sky regulators.
You can do a sub 20 million tier 2.
What?
You can do a sub 20 million tier 2.
You can elect into tier 2 with the higher disclosure.
And raise $1.
And raise it, but you're not subject to State Blue Sky?
Yeah, if you do tier 2.
If you do,
you don't have to raise a minimum of 20 million to get into tier 2.
Okay, then I stand corrected. Well,
it was a long rule proposal.
Scale disclosure, I think that this is pretty consistent with Gallagher's remarks, which is, lower, you don't need to have the same level of disclosure for large capitalization companies that you do small cap. And if you go back to the days when Intel and Microsoft went public, the prospectuses were really, really tiny compared to what we're putting out in the market. And in some respects, particularly for small companies that are dominated by retail, you're doing retail a real disservice because they just don't have the wherewithal to basically be able to read through, 150 pages worth of stuff. So that's a view. Right to compete for listed companies from other stock venues and other trading exchanges. And the reason I say that is there's got to be some critical mass economics to get these things going. And if you can't, and right now, if you're a listed company, you're basically stuck with one market structure. So it's very, very hostile in some respects. If you've got a $500 million listed company on NASDAQ and you have no or very little equity research coverage, and now all of a sudden we light up another venture exchange that may have incentives that would cause the broker-dealer community to provide equity research, shouldn't that company have the right to be able to do something which would be in the best interest of its shareholders, which is to move markets and to attract incremental research coverage? And I think that the answer is clearly they should. Right to compete for listed companies, eliminate large cap bias. And this is one that I know that I mentioned at the SEC, at the Advisory Committee on Small and Emerging Companies. Everywhere I look, people walk into, whether you're on the Investor Advisory Committee, they walk in and they don't understand how microcap markets really function. They just don't. And but they are large cap experience. They project it onto microcap markets. And so we see an enormous amount of large cap bias, which I think has gotten ourselves into this kind of pickle to begin with. Whether you're looking at the Division of Trading and Markets, there's no small cap division of the Division of Trading and Markets at the SEC. You look at FINRA, you look at DTCC. And so, what we would propose is we would like to see that all of the major regulatory structures and utilities create that core competency to focus on the specific needs, because I think if we can institutionalize that small cap, micro cap discipline in U.S. markets, we'll come up with progressively better answers from the regulators, the overseers, and the electronic clearing community. And I think that, let me see, page down. And then this is just, the last point about, I get very, very short with the idea that, low-cost trading is so wonderful for consumers. And part of that is I want people to understand these are statistics from the Pew Institute. And in 2013, the average African American in this country had a net worth of $11,000. They are not day trading stocks. They derive no benefit from from hyper-efficient, low-cost trading, but they sure need full employment and they need jobs. And there's a professor, Enrico Moretti, at the University of California at Berkeley, who in the New Geography of Jobs says that for every technology job created in an economy, there's 5 service sector jobs. This is a multiplier effect. And so if you get more of these companies public, they will employ more people. Those people will spend more money on attorneys, on dry cleaners, on restaurants, and those workers will benefit. And that multiplier, that velocity of money through the economy will start to create higher labor participation rates, fuller employment, and it will work across the entire U.S. economy. It is not a coincidence that we started to have problems creating jobs in this country at exactly the same time we dropped the bottom out of the small cap market, okay? It's not a coincidence. We think that this is the reinvention engine of the U.S. economy, which was the small IPO market, was basically gutted. And so, if you want to rebuild the economy, you can't do it by lending. These companies need something to lend to. Equity precedes debt, okay? And we've just gutted our equity capitalization mechanism in this economy. Thank you.
All right, thank you very much. We now have time for some audience questions. Jonathan, and if you could, mostly for the benefit of the people watching online, if you could state your name and institutional affiliation.
My name is Jonathan Cohen. I'm president and CEO of 2020 Gene Systems, an area biotechnology company. I'm also involved in a coalition of small biotech companies involved in an array of policy matters. Turning a bit from the future to the present, the SEC recently issued its long-awaited rules on Reg A+. I have two questions for the panel regarding this new regulatory approach. What are the characteristics of companies that you believe are most likely to succeed in a so-called IPO light created by this new Reg A+? And secondly, for companies that are either contemplating or planning to go public in this manner, what are the main things it needs to do to succeed?
So, I mean, we have companies is where I would say the company needs to have a story that is developed enough to be able to be told publicly, instead of we're trying to keep it in a back room. You know, where's a successful? You know, we had a company that worked its way up through our OTCQB market to our OTCQX and then graduated to NYSE MKT called Organovo in the biotech industry. They went from a $2 stock to a $5 stock, and they were trading 1,000 shares a day, 1,000 trades a day, 1 million shares. So, and they had a broad spectrum of institutional, retail investors all coming through, very successfully building liquidity. What did they do? Well, one, their CEO came out of Amgen. He was a very good storyteller about the technology. They print human tissue, and which is used for drug testing, and eventually they want to take the technology to be able to print you a new liver. But two, their CFO was sophisticated about capital markets, and was very good at building the investor community. So what they were given was an on-ramp to build the liquidity. So when they arrived on an exchange, they had the market capitalization, they had the liquidity. Now, I actually don't think that every Reg A Plus is going to be super active aftermarket and doesn't need to be, because others will use Reg A Plus to get a broader group of investors. If you're solving a disease, you want to go to retail, to the people who follow the disease. And many times companies will do, instead of building, when you do an IPO, you build 10x the demand. And you put some of it with long-term investors and some people who will flip it the next day, so there's secondary market liquidity. And that is going to be for some companies. Other companies will just raise enough money, like people do on private placements. Once they've raised their $20 million, they stop. And for those securities, you're not going to have a ton of secondary trading at first. But over time, as you hit your road marks, as your story succeeds, you'll have been telling your story publicly. You'll have had continuous disclosure. You'll have a record of what you said and what you did, and you will build your liquidity in. And management, because that stock that's trading 1 million shares a day, that takes a lot of management time. Some management teams won't be ready for that, and they want a quieter market, but they do want the value of raising capital that day one is tradable, because if it's tradable and if it's placeable in a brokerage system, it has value. It's on a balance sheet that's priced. And you may not need all that liquidity. So I think Reg A is going to have a full spectrum.
Anybody else on the panel wants?
I mean, I think that Reg A Plus, I mean, I agree with all of your points. Reg A Plus has been dubbed sort of the backdoor to crowdfunding, and I think that some of the things that apply in crowdfunding you would see there as well, and part of that is the story. What we've heard in the crowdfunding space is that part of the value is getting people excited about your company. And there's an opportunity for small companies to do this, where you might have a company, say a biotech company, that needs to raise a lot of money for their initial proof of concept. In the past, that was only really available through private placement. But now, if this is something where you want to start using it as almost a marketing feature, you can start to develop a brand and a client base as part of your capital raise, and there's an advantage to that.
Jonathan, in the biotech sector, I think it's going to be a little tough because you need that aftermarket support. You've got a heavy IP company. When you look at the numbers from the Jobs Act and Title I, actually the one area that actually seems to have benefited from the testing the waters provision was biotechnology in a big way, because they were able to get out and meet with institutional investors and broaden the mafia of sort of 8 institutions that used to price every deal out to about 45. There was much greater, institutional participation. So I think that, all you're doing is you're cutting disclosure with Reg A+. You haven't improved materially the aftermarket yet. I think that with heavy IP companies, that marketing is still going to be a real challenge. But because you are going to public investors, you can get out and meet with them, and you got a clear, safe harbor. So I think it'll help. I think like Title I of the Jobs Act, where just about everybody that qualified to do a confidential filing, I think about 80–90% of those companies are actually electing to do a confidential filing. It's a very high statistic. I suspect that if you can avoid the cost of going public, and you don't need to raise more than $50 million, my guess is you're going to opt as a biotechnology company to do a Regulation A+ transaction over a fully blown S1.
And you get state blue sky preemption federally. I mean, that's the point is that is a huge, and because blue sky preemption matters a lot more with small companies for primary raises, because you actually have to go to the investor. For secondary trading, you go back, the NASDAQ small cap market didn't have blue sky preemption for secondary trading. And it worked, because you really need the blue sky preemption for secondary trading when you become an investable security, when you start having these brokers out there recommending you. And we have, graduates who have $75 million market cap. They're on NASDAQ today. They're a $4 stock. And they say, no, Morgan Stanley wealth advisors won't recommend me. They don't even want to take unsolicited orders because of risk controls at the firm. And that's because the industry has moved on to be wanting to do more wrap account management of investable securities. Roche, who's ADR, who trades on our platform, really cares about blue sky because they're an investable security. And that's, so we've got to change dynamics of the industry. And I think that's where I probably diverge from David, is his chart of the IPO decline also matches up with Stratton Oakmont and the Wolves of Wall Street going out of business.
Yeah,
but
let's stop for a second, Cromwell, because we had the National Venture. I was speaking years ago at Silicon Valley Bank to their venture advisory board, and it's kind of the who's who of the venture industry, and they raised the same point. And we have another chart somewhere where we actually looked at the penny stock issuance, and it actually was a trivial amount, a relatively small amount of the aggregate. It didn't change the conclusion at all.
But there was an effect which took place, which was, so Stratton Oakmont was doing bad things. What they did was they would list companies on the NASDAQ small cap, because that got them around the penny stock rules. So these were all NASDAQ small cap IPOs, and what's kind of ludicrous is it didn't have state blue sky preemption, and they were still able to do it, but they were able to get around. But what happened was, in the industry, a real regulatory crackdown came out from FINRA, from the SEC, against any broker selling small securities. So there was a real push, and you have a second trend, which is people stopped wanting humans pushing things to them. Travel agents, anybody calling you up on the phone, we all hang up on now. But that used to be a pretty acceptable way to do things. And if you look at eBay, they use technology-driven pull. Here's something that might interest you. And that's how consumers have gone from people push to technology-driven pull. And securities markets kind of need to move forward, because we now have this incredible ability to provide some information. This might be interesting. You as an investor go research it, see if you like it. It's a smaller company, so there aren't as many institutions. You have an edge. You've got an opportunity. And that is like reflecting going forward, because I don't see how we roll back the clock to have a bunch of salesmen pushing small company securities over the phone to retail investors in this world. I mean, that's just like, but we can have technology and transparency making these opportunities available, and that's why Reg A Plus and allowing general solicitation and advertising really is the big piece for private placements, is you're turning on the lights of transparency so we can use technology-driven pull to make markets more efficient.
See, I think it needs to be both, because I agree with you, Cromwell. I don't think we're ever going to get 100,000 retail brokers that are out there smiling and dialing to retail accounts the way and that's really what
we won't be able to get a Subway sandwich afterwards. I mean,
But if you look at the institutional marketplace, just to show you how concentrated it's become, there's there's about 100 accounts now that are generating 90% of the commission opportunity to Wall Street. It's really, really, really concentrated. And that institutional market used to be much more effectively covered because we had a much higher concentration of middle market institutional sales coverage. We also had a lot of those institutional investors covered by retail brokers. And so that distribution has basically been destroyed as well. And most of those smaller institutional accounts, because they don't have liquidity constraints, are interesting to smaller public companies. So, the combination of sweetening the pie and making the incentives to get on the phone and to shoulder risk and to make markets will take it down. And by improving the fortunes of somewhat larger small companies, that will help drag up from the bottom. And then ultimately, if this combination of technology and marketing may help on the bottom end.
I just don't think Zappos is hiring Ed Bundy to sell shoes. They're building a great information experience. You can search for what kind of shoes you have. They've got feedback, how they fit. It's crowdsourced, but they've got great customer service if you've got a problem to call. But they're not, the idea of the salesman piece is something we need to let information, technology and transparency put these companies forward and remove the whole state spot so we can have interstate commerce, one system.
Is there another question? Okay. Well, thank you all for coming. And I think that there's a great deal of food for thought here. This is an important area. It's very important that we improve the secondary markets for small and medium-sized companies. But it's also important that we get the regulatory regime correct. And I'm not sure we have to have only one approach. I think there's room here for having several different approaches that would improve the regulatory structure for small cap markets. Thank you very much for coming.
Thank you.